Imagine yourself sitting high in the upper rows of a gigantic arena, watching the most important match of the season. Suddenly, the speaker announces that millions in newly created money will be dropped into the crowd. Excitement rises instantly. You prepare to catch something that could change your entire future. But then you notice that the airship carrying the money is hovering above the premium suites. People in the luxury sections don't even need to move. They simply reach out and collect the money before it ever has a chance to fall lower. Influential figures, executives, and wealthy insiders instantly grab the cash and start spending it on premium goods while prices are still low. They rush to exclusive shops and services, buying real assets and limited items before anyone else understands what is happening by acting first. They convert new money into real value while everything still seems normal. Meanwhile, you remain far above, waiting for something to reach you. By the time a few bills finally float into your hands, the situation has already changed dramatically. Vendors realize that demand has exploded and supplies are gone. To restock, they must pay higher prices, so everything becomes more expensive. Prices rise quickly because early buyers already reshaped the market. The food that once seemed affordable now costs triple. Popular items are sold out. Even though you received money, your purchasing power has shrunk. Early receivers gained an advantage without extra effort, while late receivers paid a hidden cost. This invisible mechanism mirrors how modern financial systems actually operate. This dynamic explains why everyday expenses increase faster than salaries and why major assets feel increasingly unreachable. Different groups are effectively playing different economic games. Economists describe this phenomenon as the Cantillon effect, the idea that where new money enters the system matters more than how much is created. Many people assume that new money benefits everyone equally. In reality, money spreads unevenly, and timing determines winners and losers. Historically, observers noticed that those closest to sources of wealth gained first access to opportunities, while workers and farmers felt price increases later. Today, new liquidity often enters through financial institutions and major markets rather than directly reaching households. Large investors gain early access to cheap capital, allowing them to acquire assets before prices fully adjust. This creates asset inflation, rising values in stocks, property, and scarce resources. By the time increased money supply reaches salaries, inflation has already reduced purchasing power. Rising living costs act like an invisible tax affecting essential spending. Everyday expenses such as groceries, rent, and transportation slowly increase, often without dramatic headlines. People adapt by adjusting habits, choosing cheaper options, or reducing consumption. Yet the pressure continues because price changes accumulate over time. Even small increases compound, gradually reshaping financial reality and making long-term stability feel harder to maintain. Understanding this system provides awareness so you can change strategy instead of reacting emotionally. When you recognize how money flows through the economy, you begin to see patterns behind price movements and market behavior. Knowledge shifts perspective from frustration to analysis, helping you make decisions based on structure rather than fear or short-term reactions driven by headlines. Saving only in cash during inflation can slowly erode value because purchasing power decreases over time, while cash provides stability and liquidity. Relying solely on it may expose you to long-term dilution. Many investors focus on assets that historically adjust with expanding money supply, aiming to preserve value rather than simply accumulate numbers in an account balance. Increasing income flexibility and ownership helps adapt faster to changing economic conditions, skills that allow pricing power. Independent projects or scalable income streams provide more control compared to fixed wages when income can adjust. Alongside market changes, financial resilience improves, allowing individuals to respond to inflation rather than simply absorbing its effects. Ultimately, you cannot control how money is created or distributed, but you can decide how you position yourself within the system. Awareness allows you to move from passive observation toward intentional strategy, focusing on ownership, adaptability, and long-term thinking. Small strategic shifts over time can significantly change outcomes and help you participate earlier in economic opportunities.